Good morning. First of all, I'd like to extend my sincere thoughts and prayers to all of you that were affected by the storm. Myself, our office actually was affected in New Jersey. We just actually got our power back on just a few days ago. And I consider myself very lucky to at least be able to assist with those individuals that were affected. In any event, there are a lot of questions that are coming up in reference to taxability, benefits with the IRS. And what benefits individuals can have as far as tax benefits with lost revenues. Well, unfortunately, the best thing that the government has done so far with the IRS or states, at least for the time being, is they've extended periods of time to either pay taxes and or file returns. So if you were in an affected area from the storm and you had tax returns or payroll returns that were due between the latter part of October and the first part of November, what the government has done is they've extended the time to file these returns to effectively February of this year coming up. So you have a couple of months to file the returns with an extension period of time along with the payments without penalties. It's not a lot, but it's something. One of the issues that's also coming up with a lot of employers, with employees, what kind of benefits can employees have, if anything at all? And some of you may actually be still practicing, but on a limited basis. Some of you may not be practicing at all. There are two types of individuals that most of us have as employees. One is an exempt. This is not on the list, by the way. There are exempt employees and non-exempt employees. Exempt employees are those that are professionals, other physicians, dentists, managers, and things of that nature. And there are non-exempt, exempt ones, the hourly employees. Those individuals that are hourly employees, and again, this is not on here because we just put this together yesterday very quickly, they can file in the various states under the guidelines for unemployment. So if you go on, there's a couple websites that I'll have on the latter part of the talk where they can apply for disaster relief under the unemployment regs. Unfortunately, if you heard the gentleman before from the SBA, most businesses that get benefits or funding from the SBA has it in the form of loan. FEMA, unfortunately, is for individuals. And the average FEMA grant money is between $4,000 and $5,000. It's not a lot of money. And the maximum benefit that you can get from FEMA is $31,900. It's not a lot of money. So if you're thinking that you're going to get grant money in large sums to recover your losses, chances are it's not going to happen. The SBAs and the bank will loan dollars, but again, they're loans. So whatever you're able to do as far as filling out your applications to the SBA, your local bank, by all means do so. New York and New Jersey, you also have relief for filing tax forms. Again, most of these are very similar. You can go to the websites with New York State. You can also go to our website at CintrinCooperman.com, and on our homepage, we'll have all the links for all the states, whether it be New York, New Jersey, or Connecticut, that will show you the various allowances for extended periods of time to file your returns, if in fact you have to file returns. One of the other issues that you need to be aware of is that individuals that were affected and that have substantial losses, typically casualty losses, individuals that were affected by the hurricane have various options that they can do individually. You've heard the term casualty losses. Casualty losses are items that you've paid for that you've lost value that you can take a personal deduction for against your tax return. Individuals that were affected by a federal disaster have two options. One, this particular disaster that occurred in 2012, you could file a casualty loss on your 2012 tax return. Again, that tax return isn't going to be filed until somewhere around April 15th of 2013. Or alternatively, you can elect to amend your 2011 returns. Right now, if you have if you can quantifiably come up with a calculation for that casualty loss, you can take that loss and amend your 2011 returns now and get a quicker refund. So if you're working with your accountants, what you can do is determine how big that loss perhaps may be and determine whether or not it makes more sense to actually go back and recorrect your 2011 return, or to see, in fact, whether or not it would be more beneficial for your 2012 return. And no two cases are alike. Yes, sir.
Let's say you have an office that has leased equipment in their office. They're paying off a lease for equipment.
Okay.
And those losses took place, and that particular doctor did not have flood insurance. Okay, so it's their responsibility to continue to pay that lease. It's their responsibility. Can they amend it if it's bought, if they're paying it off, are they paying it, if they're paying it through the business, can they amend their tax returns? If they're paying it personally, can they amend their tax returns on those lease losses? So in other words, somebody bought something, they have $70,000 out in the lease, the item got destroyed. How do they deal with something like that if they don't have flood insurance or any insurance to cover it?
Most of the casualty losses are losses that you take individually. Businesses themselves, okay, if you're making payments or you're amortizing the lease expense and you're actually paying the dollars, you either would get the depreciation over a period of time that you acquired the equipment, or you're getting the leasing expense deduction as you're making the payments. Typically for a business, if you're making payments on a 5-year lease and you're taking a deduction on a monthly basis or annual basis for the leasing expense, normally you would continue, unfortunately, to have to make those payments whether or not that equipment is there, because you're obligated for that, and you will get the deduction as you're making the payments. You'd still be required to make the payments, unfortunately.
If you are, how is it looked upon, to your knowledge, you're rebuilding, let's say you get things in before December 31st, do you get your disaster relief claim, or whatever the term would be, plus, I guess it's like a double dip, your end of the year tax benefit? Does one supersede the other, or can you do both?
Very good question. If you're receiving a disaster relief benefit that is non-taxable, it depends on who's giving you the benefit, or an insurance reimbursement. And it's important, too, timing-wise, because we're coming to the end of 2012, and this also happens to be the same time that the Bush tax benefits are expiring. So January 1st, 2013 is a very important planning technique, which was brought up very, typically, if you recall, most people that bought equipment the last 5 or 10 years were able to take the accelerated depreciation under Section 179. This year, it's been reduced to 139, was it 139, Gary, this year? Next year, it's only $25,000. So if, in fact, you are either rebuilding or putting your office back together and you're acquiring new equipment, based on the facts and circumstances, if I was able to acquire the equipment in December 2012, I'd much rather do that than January 1st, 2013, because we don't know what the laws are going to be. As of right now, the limitations are only $25,000 in 2013. It's nominal. And in addition to that, one of the other major changes that affect, for example, most dentists, and also physicians and veterinarians, is software cost. They're also changing the deductibility of software costs. You know, a lot of softwares that a lot of you utilize are very expensive. You know, they're actually part and parcel of your fixed assets. So if you're buying a piece of software that costs $20,000 or $30,000 or more, and you're going to acquire that software after January 1st, 2013, you are no longer able to take the accelerated depreciation on that software, and you have to amortize it over the expected life of that software, typically 5 or 7 years, unless you get rid of it earlier. So if you're going to be rebuilding or acquiring assets, okay, what you may want to do is to work with the bank or the Schein organization and get that into place sooner than later. At least you have the ability of making decisions. If you acquired it in December 2012, before you file the returns in 2013 for 12, you're better able to make a decision on what is the most beneficial advantage for yourself based on your facts and circumstances. And perhaps you will, in fact, take the accelerated depreciation in 2012. Maybe you won't. But at least it gives you the opportunity, because as of right now, you're going to lose that benefit. It's gone, unless Congress changes the laws, and in all likelihood, it looks dismal in that respect, because if they're allowing you to have accelerated write-offs in the future, they're not going to get the tax revenue. So once again, if you're able to do the acquisitions in December 2012, much better off than January 2013. In addition, if any of you are going to be assisting employees, okay, if you give assistance to employees that were also affected from the storm, you're able to make those payments to an employee, which is non-compensatory to the employee if it allows them to assist them through their turmoil within the storm itself. And you could deduct it as a business expense. So if you're actually giving an employee a benefit, a disaster relief benefit, as paying it by you, the employer, you could take a deduction, and it's not compensatory for your employee. So if you're able to assist an employee, you could actually give them a great benefit. And based on the current regulations, it's non-taxable. It's not. It's a great benefit, if in fact you're able to do it. The other thing that we're finding out right now is that there are tremendous planning opportunities, or there are compliance problems. What we're finding out with a lot of our clients is that we're also finding that a lot of their records were not as sufficient as they should be. And if in fact they're not in great shape, you're going to have difficulty with your insurance companies when it comes time to filing claims with those insurance companies. So for example, if you have business interruption insurance and you make a claim with your carrier, what does the carrier do when you make the claim? Well, first of all, they determine whether or not you actually qualify under their guidelines and the policy itself to see, in fact, whether you do qualify. And if, in fact, you do qualify, they want to see your accounting records to see what losses were actually sustained and what your overhead is. And what do they typically look at? They typically look at the last 2 years' tax returns and some current financial data for the current year. So, for example, if you have your 2011 and 2010 business returns in place, and hopefully you already filed the old years, some of you have not, and you have reasonable records, at least for the first 6 months of this year, if your overhead for the first 6 months of this year was actually reduced, they're going to use those figures versus the old figures, if in fact you qualify. We're also finding, from a compliance perspective, that a lot of employers, physicians, dentists, veterinarians, don't have the appropriate documentation from their employees. For example, how many of you ever heard of a form, an I-9 form? Does anyone know what an I-9 form is? A couple hands. Every employer has employees fill out various forms when they hire employees. Typically a W-4 form. We all know what a W-4 form is. The other one's called the I-9 form. An I-9 form is actual a federal employment form that's required by every employer to be filled out by an employee. It's informational, and it's actually run by the Homeland Security Division of the United States. It's a federal form, and that form asks the employee to fill out their name and address, and it asks the employer to take a look at some various documentation to support that, in fact, that person is who they're saying that they actually are. So if Mary Jones has worked for you for 20 years, or you hire a new person, it doesn't matter. They're supposed to give you some documentation, a driver's license, a passport, usually 2 pieces of identification to show you, in fact, that they are who they say they are. You take that document and you put it in your employee file. If you don't have that document, I can tell you that there is a fine per employee to an employer of $1,000 for noncompliance. And the reason why I'm saying that, as silly as it is, now that we're looking at everyone's accounting records, we're finding out that the employee files were never up to date. And the other reason why I'm telling you that is I had a client about a month ago call me up one day. I was out of the office, and he texted me, "Please call me, it's an emergency." I said, "What's the matter?" He said, "Well, I got to my office, and there's 2 gentlemen here from Homeland Security, and they're telling me they're doing an audit, and they want to see my I-9 forms." He said, "What should I do?" I said, "Show it to them." So he happened to be a very large employer, and the reason why they were looking at him is he did have a number of employees, and a lot of his employees were individuals from that were born outside the United States, ironically, and easy for them to look. They gave him 24 hours to actually come up with the forms. They came back, and out of the 35 employees, he actually came up with 33 forms. He's waiting for his $2,000 fine to come in the mail. So just as an aside, it's very important that all of you are aware of these different scenarios. Yes, sir?
If you have these forms have been destroyed and lost in the storm, what do? You have to have them redone now?
You're actually the first one to answer that question. I would say if the forms were destroyed, okay, and if you were asked to actually show the forms, I think you have a reasonable excuse for not having the forms. However, going forward,
Yeah.
if your records were destroyed and you're going to continue business with the same employees or employees, period, you should comply with that regulation. So if the forms were not there or aren't there, and you have the ability now to have the employees fill out a current form, I would have them do so.
Okay, just redo the whole thing.
Redo it.
Okay, also, before you mentioned about maybe going back and deducting from 2011 to help with your taxes, maybe get refunds or whatever from your
Yes.
taxes. How will that affect you when you're applying for the loans and things like that? Is it something you shouldn't do if you're trying to get SBA loans and things like that?
That pertains to a casualty loss, and that's a personal casualty loss. For example, if my home was substantially destroyed, or I lost my first floor, and I wasn't fully insured, and the cost to bring that back to the prior situation was $60,000. Okay, let's say the fair market value change or my out-of-pocket cost was $60,000. You have a casualty loss of a $60,000 value. What does that mean? It's not a dollar-for-dollar deduction. Casualty losses individually are deductible when they exceed 10% of your adjusted gross income in the year filed, less $100. So depending upon your facts and circumstances for your income for 2011 and or for 2012, you would weigh out which is the most advantageous filing mechanism for yourself. And that may be very different than somebody else. However, that being said, it's also a planning opportunity. As horrible as it is, okay, let's say 2012 was as good a year as 2011. Maybe it was, maybe it wasn't. And perhaps you're going to acquire new equipment from the Schein Corporation in December of 2012. it's very possible that your income this year may be substantially less than 2011, and your filing for that casualty loss would be more valuable in 2012 versus 2011. So there's some planning opportunities that can be had in these circumstances.
Right, so with those casualty losses, should I be putting in every piece of furniture in the bedroom and every piece of clothing and make a list of all these casualty
Definitely.
losses?
Definitely,
Okay,
of course.
all right.
What happens if your business, you're a sole practitioner, you're not in a PC or incorporated, or, you're not anything like that? Can you claim those casualty losses? Or is that-
Bi- yeah. Business losses are handled differently than individual losses, okay? Casualty losses are for things that you have individually. Business losses are separate. So typically on the business side, if you've expended dollars or you've depreciated items, you've already written them off in the form of an expense anyway. You can't get it twice. You can't get it 2 times.
Well, I don't know if my question is similar, but do these casualty losses impact your business tax return and then your K-1 as a result?
Casualty losses are filed on your individual return. It doesn't affect your business income. It actually flows through your itemized deductions. Gary, it's a flow through on Schedule A, correct?
Yes, but one of the things, if I may,
It's Gary Bagoff, ladies and gentlemen.
to expand on what Ken said regarding your business property, if you bought a piece of equipment for $20,000 and you took depreciation deductions of $10,000 before the loss, you had unrecovered cost or basis of $10,000. So on your business return, if the piece of equipment was totally destroyed, you would still have a $10,000 deduction on your business return. So it's a facts and circumstance situation depending on when you purchased your equipment, how much depreciation you've taken, and was it a total or partial loss. And if I may, I just want to expand on the I-9 forms. People have a tendency to go ahead and you have to look at certain documents, whether it's a passport or a Social Security card or a driver's license. What you're supposed to do is look at those documents, write the numbers down on that I-9 form, which is that immigration form, and not keep copies of those documents in your files. That's what the law requires. So a lot of people and folks don't know that.
Once again, depending upon your individual situation, you need to weigh out when you're going to spend capital to rebuild your practice or your home, and what the timing is. But once again, the business aspects are very different than the individual aspects for tax purposes. The other thing that you want to be aware of also, going forward next year with the new tax laws, for those individuals that presently, for married couples that exceed $250,000 of adjusted gross income, if you have interest, dividends, and passive income going forward, that's going to be subject to the new 3.8% Medicare tax. So for those of you that have incomes that exceed $250,000 for married couples or $200,000 for an individual person, once again, under the new tax code, effective 1/1/13, your interest income, your dividend income, and your net real estate income, if you have rental properties, will be subject to a surtax of 3.8%. So not only are our rates going to be going up in 2013, there's also this Medicare surtax is also going to be there. So even if you're in the same rate, if you have interest, dividends, and real estate income as well, there'll be an additional 3.8% tax on those items. It's pretty substantial.
If I just may add to that, municipal bond interest is not subject to that Medicare surcharge tax. So there's planning opportunities to discuss with your accountant or your investment advisor on what type of investments you should be holding, whether you want to switch away from dividend-paying securities and think about going to municipal bonds. And also subject to that unearned or investment income or unearned income tax is also annuity income as well. Things that aren't included or not subject to that tax is distributions from qualified retirement plans. So muni bond interest is not included, and any distribution from a qualified retirement plan. So there's a lot of careful planning that needs to go into figuring out what you need to do, and to do it ahead of time is what we advise, as opposed to waiting to the end and rushing.
Once again, all the states have different requirements and advantages and deferrals for filing different forms. So if you went to our website at CintrinCooperman.com, you can get all the links, whether you be in Connecticut, New York, or New Jersey, for all the pros and cons and the deferrals of filing forms and so on. You could also reach Gary or myself at our office number, which you can see on the website as well. Once again, there's a large misunderstanding of the benefits and cash flows that are out there by the government and the state agencies. And unfortunately, most of them are loans. There is grant money out there, but the bulk of the dollars that are available to businesses are going to be in the form of loans. And as far as the timing is concerned, if you're able to or need to acquire new equipment, it'd probably be advantageous to weigh out whether or not you do it in 2012 or 2013. But if your physical facility has the ability of getting that equipment in there and you're able to utilize it, you may want to consider doing it sooner than later. But again, for that Section 179 expense deduction, it's supposed to be in service in 2012. So you can't just buy it and leave it in the box. You're supposed to utilize it. Any other questions? Gary, anything you may want to add?
Everything was great.
Thank you.